The early signs of financial stress on farms don't show up in bankruptcies. They show up in unpaid operating loans, decreases in working capital, and how much financial pressure gets carried from one year to the next. Recent Ag Economy Barometer data helps us see those signals. I'm Michael Langemeier with Purdue Center for Commercial Agriculture. We've been tracking producer perspectives on operating loans, financial stress, and balance sheet strength for several years. The latest data doesn't point to widespread financial distress, but it does suggest that financial resilience may be tightening at the margin. A growing share of producers report they expect their operating loans to be larger than the previous year. That by itself isn't unusual. Every year we see some people think their operating loans are going to be larger, but the key question is why that borrowing is increasing. The most common reason producers give is higher input cost. That's consistent with today's production environment in which we see very high corn and soybean break-even prices, for example, compared to their pre-COVID levels. But we're also seeing more producers say that their operating loan is larger because of unpaid operator debt from prior years. That's an important distinction. It suggests some financial pressure isn't being absorbed within a single year, it's being carried forward. To capture this, we developed a simple index of financial stress. Essentially, what we're doing here is we're multiplying the percent that say we have larger operating loans by the percent that say that the reason that they have larger operating loans is carryover debt. The index reached its highest level in our data series in 2026. We've been tracking this since 2020. This does not signal a crisis necessarily, but it does indicate that financial stress is increasing at the margin. We also asked producers whether they believe they have a strong balance sheet. We've been asking this on and off for several years. 90% agreed or strongly agreed that they had a strong balance sheet. In the spring of 23, obviously a very high number. More recently, that number has declined. In January 26, 75% agreed or strongly agreed that they had a strong balance sheet. The fact that the balance sheet remains relatively strong is reducing financial stress, but it certainly doesn't help solve the problem associated with negative cash flows. The equity positions remain solid for many farms. That's what we found from the recent results related to the strength of the balance sheet, but some of the financial cushion built during stronger income years has been drawn down. We do not make a distinction between liquidity and solvency on balance sheets. I think solvency is more solid than liquidity. We've seen liquidity reduced, specifically a reduction in the current ratio in the last few years. For corn, soybean, and livestock producers, this matters because financial pressure typically shows up in working capital and liquidity first, not in land values or equity. When that cushion gets thinner, operations become more sensitive to price swings, yield shocks, and cost surprises. These trends are a good reason to step back and evaluate your own financial resilience. Ask the following questions. Is my operating loan growth tied to higher costs, an increase in farm size, or am I carrying debt forward? If you're carrying debt forward, why are you carrying debt forward? Is it because you're having trouble paying principal payments? That would be a sign of financial stress. Another question, how strong is my working capital cushion relative to today's volatility? When you have a lot of volatility in the market, you need a higher current ratio to weather the storm. If margins tighten further, which costs of my farm can be adjusted, if any? Finally, could my operation absorb a poor year without a major disruption? One of the reasons why ag economists say that we need a current ratio above 2, a 2 to 1, it means that we can have 2 years in a row of fairly tight margins and still have some liquidity. And so we need to really pay attention to our working capital. These questions help determine whether your operation is positioned for resilience in a tighter margin environment. If you wanted to evaluate your farm's financial position and decision-making under tighter margins, we recommend watching our video, Thinking Like a CFO for Your Farm Operation. It walks through how to assess performance, risk, and financial resilience from a management perspective. For those who want to explore the data in more detail, you can also read our article, Rising Farm Debt and Financial Stress, Evidence from the Ag Economy Barometer. You'll find it along with additional farm management resources at purdue.edu/commercial ag, where we break down these operating loan trends, the financial stress index, and balance sheet measures more fully.